You just closed a losing trade. You're down $100. It's not a huge loss. It's within your risk limits. Your strategy can handle this loss. Everything should be fine. But it doesn't feel fine. You're sitting there looking at your account balance, and all you can see is that red number. That $100 that's gone. That money you worked for. That money you could have spent on something else. And now it's just gone. Your mind starts racing. You think about how you could have avoided this loss. You replay the trade in your head. You see all the signs you missed. You feel stupid for taking the trade in the first place. Then another thought creeps in, a dangerous thought. I can get that money back. I just need one good trade, one winner, and I'll be back to where I started. I'll be back to break even. You look at your charts again. You're searching. Not for your normal setup. You're searching for anything that looks like it might move. Anything that could give you a quick win. Anything that could recover that $100. And you find something. It's not your best setup. It doesn't meet all your criteria, but it looks like it might work. And more importantly, it's happening right now. You don't have to wait. Here's where the danger multiplies. You're not just taking a questionable trade, you're also thinking about position size. And that voice in your head says, if I risk the normal $50, I'll need 2 winning trades to recover. But if I risk $150 on this one trade, I can recover everything and even make a profit. One trade, and I'm back to positive. So you do it. You take the trade with triple your normal position size. Your heart is pounding. You're watching every tick. This has to work. This needs to work. But it doesn't. The trade goes against you. And now you're not down $100, you're down $250. And the cycle starts again, even more intense this time. This pattern destroys more trading accounts than bad strategies ever could. It happens to beginners. It happens to experienced traders. It happens to people who know better. And it happens over and over until the account is empty. Let me tell you about Yale, who lost $23,000 in 6 weeks because he couldn't stop increasing his risk after losses. Yale had been trading consistently for about a year when his downward spiral began. He had a decent strategy with a 58% win rate. He was growing his account slowly but steadily. Nothing dramatic, but real progress. His account had grown from $10,000 to $14,500 over 8 months. Yale felt confident. He felt like he was finally figuring out trading. He was making about $500 to $600 per month on average. It wasn't life-changing money, but it was consistent. Then came that Tuesday in March. Yale took a trade that looked perfect. All his indicators aligned. The trend was clear. The entry was textbook. He risked his standard 2% of his account, which was $290. The trade lost. Just one of those trades that doesn't work out. No big deal, right? His strategy expected losses. This was normal. But Yale didn't see it as normal. He saw his account drop from $14,500 to $14,210, and something in his brain just couldn't accept it. He'd been on a winning streak for 2 weeks. He'd made $800 during those 2 weeks. This loss wiped out more than a third of that progress. Yale immediately started looking for another trade. Not his normal process of waiting for valid setups, urgent searching. He needed to recover that $290. He found a setup that was marginal, not terrible, but not great. His rules said to skip it, but Yale took it anyway. And here's where Yale made his critical mistake. He risked $500 on this trade instead of his normal $290. Yale told himself he was being strategic. This setup might not be perfect, but if I risk more, I can recover faster. Plus, I'll be more focused because there's more at stake. The trade lost. Now Yale was down $790 from his peak. In 2 trades, he'd erased almost 2 weeks of gains. And Yale couldn't stop. The bigger the loss, the more desperate he became. The more desperate he became, the more he risked. The more he risked, the bigger the losses became. Over the next 6 weeks, Yale spiraled. He would take a loss, then immediately take another trade with bigger position size. That would lose too. He'd increase his size even more. Some trades won, which kept Yale hoping, but the losses were so much larger than the wins that his account bled steadily downward. Yale's normal position size was 2% of his account, but during this 6-week spiral, Yale's average position size was 6.8% per trade. He took trades risking 10%, 12%, even 15% of his account, all in attempts to recover from previous losses. By the end of those 6 weeks, Yale's account had dropped from $14,500 to $1,200. He'd lost $13,300. But here's what's really painful. If Yale had just maintained his 2% position size, even taking all the same trades, he would have only lost about $2,800. He would still have $11,700. The difference between $11,700 and $1,200 wasn't bad strategy. It wasn't bad luck. It was increasing his risk after losses. That decision alone cost Yale $10,500. Yale sat looking at his nearly empty account, trying to understand what happened. He wasn't a reckless trader. He knew about risk management. He'd been successfully managing risk for 8 months. So why did he suddenly lose control?
Yale's confusion about his own behavior led him to research the psychology behind what had happened, and what he discovered explained everything. What Yale experienced has a name in psychology: loss aversion combined with the sunk cost fallacy. But let's break that down into simple terms that actually make sense. Your brain hates losing more than it loves winning. This isn't about trading. This is about being human. Studies show that the pain of losing $100 feels about twice as strong as the pleasure of gaining $100. This is called loss aversion, and it's wired deep into your brain. Your ancestors, who were more afraid of losses than excited by gains, were more likely to survive. If you lose your food, you might starve. If you don't gain extra food, you're just not slightly better off. So your brain evolved to make losses feel really, really bad. Worse than gains feel good. When Yale lost that first $290, his brain didn't think, oh well, that's trading, losses happen. His brain thought, emergency, we lost resources, fix this immediately. This triggered what Yale now calls loss recovery mode. His entire focus shifted from trading his strategy to recovering his loss. And when you're in loss recovery mode, you stop thinking rationally. Here's what happens in your brain during loss recovery mode. Your emotional brain takes over. Your rational brain, the part that understands risk management and probability, gets pushed aside. Your emotional brain has one goal: make the pain of the loss stop as quickly as possible. How do you make the pain stop? By getting the money back. How do you get money back quickly? By taking another trade. How do you get all the money back with one trade? By risking more. Yale's brain wasn't trying to destroy his account. Yale's brain was trying to help him feel better. It genuinely believed that recovering the loss would make Yale feel better. And it was right about that. Recovering the loss would have made Yale feel better. The problem is that the fastest path to recovery is also the riskiest path. And the riskiest path is how accounts get destroyed. Yale discovered something else in his research: the sunk cost fallacy. This is the tendency to throw good money after bad because you've already invested so much that you feel like you can't stop now. After Yale lost that first $290, then lost another $500 trying to recover it, his brain thought, I've already lost $790. I can't stop now. I need to keep going until I recover it all. Stopping now means accepting the losses as real and permanent. So Yale kept trading, kept increasing his risk, kept chasing recovery. Each new loss made it even harder to stop because he'd now invested even more. The hole kept getting deeper, but stopping felt like admitting defeat. This is why recovery spirals are so dangerous. Your brain fights against stopping because stopping means accepting the losses as real and permanent, but continuing means risking even more. Understanding the psychology was helpful, but Yale realized that certain situations made his risk-increasing behavior even worse, and recognizing these triggers was crucial. Yale reviewed his 6-week spiral and noticed that not every loss led to increased risk. Some losses he handled normally, but 3 specific types of losses almost always triggered the spiral. Understanding these triggers helped Yale recognize danger moments. Trigger 1, the should-have-won loss. When Yale took a trade that looked perfect, every indicator aligned, textbook setup, ideal entry, and it still lost, he would spiral, almost immediately. Why? Because these losses felt unfair. His brain couldn't accept it. I did everything right. This should have worked. The market is wrong, not me. These losses triggered intense recovery behavior because he felt cheated. If the market was wrong, then he deserved to get his money back. So he'd immediately take another trade, often risking more to correct the market's mistake. Trigger 2, the streak-ending loss. When Yale had a winning streak going and one loss ended it, that loss felt much worse than a normal loss. Yale would have 5 winning trades in a row. He'd be feeling confident, his account would be growing. Then one loss would happen, and Yale's brand would panic. The streak is over. Everything is falling apart. I need to start a new streak immediately. Yale would take aggressive trades trying to start a new winning streak, risking more than normal because he felt like he was falling behind. Trigger 3, the end of day loss. When Yale took a losing trade near the end of his trading day, he absolutely could not walk away. Ending the day with a loss felt unbearable. His brain would think, I can't close my laptop with my account in the red. I can't end the day as a loser. I need at least one win before I stop. So Yale would keep trading past his normal hours, taking questionable setups, risking more than normal, all to avoid the psychological pain of ending the day with a loss. These 3 triggers, unfair losses, streak-ending losses, and end-of-day losses, were responsible for 80% of Yale's oversized risk trades. Just recognizing these triggers wasn't enough to stop the behavior, but it was the first step. Once Yale knew when he was most vulnerable, he could create specific defenses for those exact moments. Recognizing his triggers was progress, but Yale quickly learned that the standard advice about risk management completely failed to address his real problem. Every trading book says the same thing. Never risk more than 1 to 2% of your account on any trade. Yale knew this. He'd followed this rule successfully for 8 months. But when he was in loss recovery mode, that rule meant nothing. Here's why normal risk management advice fails. It assumes you're thinking rationally. It assumes you can just decide to follow the rule and you'll follow it. But when you're in loss recovery mode, you're not thinking rationally. Your emotional brain is in control, and your emotional brain doesn't care about risk management rules. Your emotional brain only cares about recovering the loss and making the pain stop. Yale tried reminding himself of the rules. He put sticky notes on his monitor. Risk only 2%. He set his position size calculator to default to 2%. He wrote trading rules in his journal. None of it worked. When Yale was triggered, when he was in loss recovery mode, he would bypass all these safeguards without even thinking about them. He'd see the sticky note and think, that rule is for normal situations. This situation is different. I need to recover this loss. He'd override his position size calculator without hesitation. He'd ignore his written rules. The problem wasn't that Yale didn't know the rules.
The problem was that rules require rational thinking, and loss recovery mode shuts down rational thinking. Yale realized he needed a different approach. He couldn't rely on remembering rules or having discipline in the moment. He needed to design his trading environment so that increasing risk was either impossible or extremely difficult. He needed to protect himself from himself, not through willpower, but through structure. After losing $13,300 to risk escalation, Yale finally developed a system that worked, but it required completely changing how he approached position sizing after losses. Yale's solution had 3 layers of protection. Each layer worked independently, but together they made it almost impossible for him to increase risk after losses. Layer 1. Pre-calculated position sizes. Every Sunday evening, before the trading week began, Yale would calculate his position sizes for the entire week. Not in the moment, not when emotions were high, but when he was calm and rational. Yale would look at his current account balance and calculate, 2% of my account equals X dollars. That's my position size for every single trade this week. No exceptions. Yale would write this number on an index card and tape it to his monitor. That number didn't change during the week no matter what happened. Win or lose, that was his position size. This removed the decision from the moment. Yale didn't have to decide position size when he was emotional. The decision was already made when he was rational. Layer 2. The post-loss freeze. After any losing trade, Yale implemented a mandatory 60-minute freeze. He couldn't take another trade for 60 minutes. No exceptions. Not if an amazing setup appeared. Not if he saw the perfect recovery trade. 60 minutes minimum. But here's the crucial part. Yale also closed his trading platform during those 60 minutes. Not minimized, closed completely. And he left his office. Yale would go for a walk, go to the gym, run errands, anything that physically removed him from his trading desk. Why 60 minutes? Because that's how long it takes for the intense emotional reaction to a loss to fade. After 60 minutes of doing something else, Yale's emotional brain would calm down, his rational brain would come back online. When Yale returned after 60 minutes, if a valid setup existed, he would take it, with his pre-calculated position size. But 90% of the time, the urgent need to trade immediately was gone. Yale could think clearly again. Layer 3. The daily loss limit. Yale set a maximum daily loss. If he lost 6% of his account in a single day, 3 trades at 2% each, he was done trading for the day. Platform closed, computer off. This rule protected Yale from spiraling within a single day. Before, Yale might take 5, 6, 7 trades in one day trying to recover, each with escalating risk. The daily loss limit capped the damage. But Yale added an important twist. The daily loss limit included trades taken outside his strategy rules. If Yale took a random trade because he was emotional and it lost money, that counted towards his daily limit. This incentivized Yale to only take valid setups. Taking an emotional trade didn't just risk money, it used up one of his 3 allowed trades for the day. These 3 layers worked together. The pre-calculated position size meant Yale couldn't easily increase risk. The post-loss freeze meant Yale couldn't immediately chase recovery. The daily loss limit meant Yale couldn't spiral indefinitely. Within 3 weeks of implementing this system, Yale had not increased his position size even once after a loss. Not because he suddenly had better discipline, but because the system made it structurally difficult to do so.
Implementing this 3-layer system didn't just stop Yale from increasing risk, it transformed his entire relationship with losses in ways he never anticipated. Benefit 1. Losses stopped feeling like emergencies. Before the system, every loss triggered panic. Yale's brain would scream, "Emergency! Fix this now!" His heart would race, his hands would shake, he'd desperately search for a recovery trade. But with the mandatory 60-minute freeze, losses became routine. Take the loss, close the platform, leave the office. Same procedure every time. Losses stopped feeling like emergencies and started feeling like normal trading outcomes. After a few weeks, Yale's physical response to losses changed. His heart didn't race anymore. His hands didn't shake. A loss was just, okay, that happened. Now I follow my procedure. Benefit 2. Better trade quality. When Yale knew he had limited trades per day, his daily loss limit created an indirect trade limit. He became much more selective. He didn't take marginal setups because each trade was precious. Before, if Yale saw a questionable setup, he'd think, why not? I can always take more trades. After implementing the system, Yale would think, is this worth using one of my trades for today? This selectivity improved Yale's win rate from 58% to 64%. Same strategy, but only taking the highest quality setups. Benefit 3. More time for life. The post-loss freeze meant Yale spent less time at his trading desk. Before, Yale might spend 8 hours a day trading, much of it chasing losses. After the system, Yale might only actively trade for 2 hours a day. The 60-minute freezes gave Yale his life back. He went to the gym regularly, he saw friends, he worked on other projects. Trading became one part of his life instead of consuming his entire existence. And surprisingly, having a life outside trading made him a better trader. When trading was Yale's entire identity, every loss felt personally devastating. When trading was just one thing Yale did, losses were easier to accept. Benefit 4. Account growth. This is the obvious benefit, but it's worth stating. Yale's account started growing again, consistently, steadily. In the 3 months after implementing his system, Yale grew his account from $1,200, what remained after his spiral, to $4,800. That's 300% growth, but it was growth from a low base after his losses. More importantly, Yale's monthly returns became predictable. He made 8 to 12% most months, some months less, some months more, but overall consistent and positive. The same strategy that worked before his spiral was working again. The only difference was that Yale wasn't sabotaging himself by increasing risk after losses.
Yale's transformation from account destroyer to consistent trader offers a clear blueprint for anyone who struggles with increasing risk after losses. Here's exactly what you need to do, starting right now. Step 1. Calculate your loss from risk escalation. Review your last 50 trades. Identify trades where you increased your position size above your normal risk. Calculate how much money you lost specifically from those oversized trades compared to if you'd used your normal position size. Write this number down. Make it real. This is the cost of your risk escalation habit. Step 2. Identify your triggers. Look at the trades where you increased risk. What happened right before? Was it after a loss that felt unfair? After a winning streak ended? At the end of your trading day? Write down your specific triggers. These are your danger moments. These are when you need the most protection. Step 3. Calculate your standard position size. Right now, before you're emotional, calculate your position size. Take 1 to 2% of your account balance. That's your position size for every trade. Write it down. This decision is made now when you're calm. Don't allow yourself to recalculate in the moment. Step 4. Create your post-loss procedure. Write down exactly what you will do after a losing trade. Close the trade. Record it in your journal. Close your trading platform. Leave your office. Do specific activity for 60 minutes. Then return and evaluate if valid setups exist.
Make this procedure specific. Don't just say, take a break. Say exactly what you'll do. Step 5. Set your daily loss limit. Right now, decide what's your maximum daily loss. Most traders use 4 to 6% of their account balance. Once you hit this limit, you're done for the day. Write this limit down, make it a hard rule. Computer off when you hit it. Step 6. Remove temptation. Make it difficult to override your position size. Some traders have a trading partner who has to approve any position size changes. Some traders use platforms that can lock position sizes. Find what works for you. The key is creating friction. Make increasing your position size require multiple steps and deliberate action, not just a moment of emotion. Step 7. Track your compliance. For the next 30 days, track one thing. Did you stick to your pre-calculated position size on every trade? Your goal is 100% compliance, not 100% winning trades, not 100% profit, just 100% compliance with your position size rule. If you can achieve 30 days of position size compliance, you'll break the risk escalation habit. You risk too much after losing a trade because your brain desperately wants to recover the loss and make the emotional pain stop. Your emotional brain takes over, shuts down rational thinking, and pushes you to take aggressive actions. The solution isn't more discipline. The solution isn't trying harder to remember the rules. The solution is creating a system that makes risk escalation structurally difficult. Pre-calculate your position sizes when you're rational, not emotional. Implement a mandatory post-loss freeze that removes you from your trading desk. Set a daily loss limit that caps the damage from any potential spiral. These 3 layers of protection worked for Yale. They can work for you too. Yale lost $13,300 learning this lesson the hard way. You don't have to. You now know why you increase risk after losses and exactly how to stop doing it. The real question is, will you? Will you build the system that saves you from your next emotional spiral? Will you protect your account from the person most likely to blow it up? You! Because in trading, your biggest risk isn't the market. It's your mind. And your entire account depends on how you manage it.